Hey everybody, Dan Rawitz here, University of Options. Happy Sunday. Hope you're having a good day. We have sunshine again. I'm happy about that. What a horrible winter it's been, although it hasn't been long. Actually, it was a horrible fall. A lot of rain, a lot of cold. Okay, so enough of the small talk. We got 10 slides on the economy, and I have 10 slides on the market. And I'll start off by telling you that it is frightfully good. The economic stats we're seeing, we'll talk about corporate earnings later, but you can see the actual GDP for 2025 came in for the third quarter at 4.3. And the Atlanta Fed model, which had come down to like 1.7 forecast, is now saying 5.1. Goldman Sachs for the year, a little more conservative at 2.6. I'm still very concerned about job growth, lack thereof, and it's hard for me to imagine the economy continuing to stay strong with job growth shrinking. Let's see, inflation, 2.7% year over year, 2.6, pretty nice. We're looking at Q1, maybe a little jump to 3.3, could be tariff related. The bottom line here is that inflation is okay. It's still above the Fed target, which is 2%, but it's manageable. Labor market is cooling but resilient. We'll see about the resilient part. Unemployment's 4.4. That's the lowest. That's the highest since October of 22, I believe. And the hiring rate, 3.2%. That's the weakest since 09. This is what's scaring me. Job opening, 7.1 million. That's a pretty big drop from where it was. So the mixed signal here is the labor market is showing clear signs of cooling, for sure. Hiring rate is the weakest since the Great Recession. And the quit rate at 2% is signaling workers' caution, meaning they're afraid to change jobs. Goldman forecasts unemployment to stabilize at 4.5, which would be another increase. So without hiring and job growth, we will not see a sustainable economy. Fed Reserve, we're still at 3.5 to 3.75 on the Fed Reserve. This is down considerably from its peak last year. The next FOMC meeting is coming up in a couple of weeks here. That's January 27th and 8th. And the market is now priced at 95.4% chance of no change. So I would not be looking for the Fed to ease this time around. These market forecasts are usually pretty good because it's the futures market that's being used to help predict those moves. And the Fed's December dot plot at its last meeting showed only one cut projected for 2026. That may change. The market expects two cuts, ending the year at about 3%. So the dot plot, at least the market feels, is a little too hawkish. Fed leadership changes. This is big, guys. I mean, we've had Powell for how long? I lost count, but it's been a long time. His term expires May of 2026. He's got only 3 more FOMC meetings to oversee, and we should see a new Fed chair nomination pretty soon, actually. And I would look for at least the nomination to be a very dovish Fed. Trump this last week, in case you're living under a rock, it told the Treasury to buy $200 billion of bonds, mortgage bonds. He's doing everything he can, Trump is, to lower interest rates right now. I don't know if that's going to help or not. The market actually went the other way. 200 billion is not a big number to try and move the market. It's more about, I think, the gesture and the president showing how badly he wants rates to come down. And the 200 billion, sorry, same story though. He decided to not close Fannie Mae, Freddie Mac back in his first term, and that company now has 200 billion in cash since that decision. So he wants to spend it on buying bonds, which helps the market. That's good. Whether you like Trump or not like him, I think you'd agree that's probably a decent move for the overall mortgage market. So the voting members that are coming in that we have not seen, Beth Hammock, she's the hawkish member. Philadelphia Fed president, the Dallas Fed president, and the Minneapolis Fed president. Of those, the only real hawkish person we're losing or gaining, unfortunately, is Beth Hammock. And then we're losing the following Feds. Obviously, we're going to lose the ones that we're gaining. Sorry, yes, we're gaining new Feds in these areas, so we have to lose those Feds. Consumer spending is still strong. I haven't seen current numbers to really make me feel comfortable about that. These were really kind of end of year numbers, and talking about solid wage growth outpacing inflation. That's good, but you got to create jobs as well. High household net worth. This has to do with mostly with the stock market, but unfortunately, this is creating an uneven playing field, more so with the rich getting richer and the middle to lower middle class. They're not seeing as much pickup from the stock market appreciation. Credit card delinquencies are rising. That's never good. And holiday retail sales did exceed expectation. And that's really where this consumer spending statement is coming from. A 2026 outlook for consumer spending is tax refunds and potential tax cuts from the One Big Beautiful Bill Act could provide additional consumer tailwinds. However, the tariff-driven price increases may dampen any spending we could see in Q2 or Q3. So you really do have this mixed bag here. I'm not sure which is going to win. Housing market is just astounding. Okay, rates are 6.8%. Yet home prices still grew 4%. Home prices are growing every year despite the worst housing affordability in history. Existing home inventory is still low. Now, this is because people are trapped in their mortgages. If you have a 3% mortgage, are you going to want to move up into a home with a 6.8% mortgage? Buyers are okay when they decide to move up with a bigger payment because of a higher house price. But you take the higher house price plus the doubling of their interest rate, it's just untenable. They're not going to do it, and they're not. And that is what's keeping the housing market in check. If not for that, I can't even tell you what will be happening right now with housing prices. So this is actually turning into be a really good thing. The term here used is existing home sales constrained by lock-in effect. People are literally locked into their homes. Home construction is picking up to meet demand. That's good. As long as housing inventory is low, builders will do well and they'll keep building. Shelter inflation is moderating, which is good for CPI. So the wild card for tariffs, the elective tariff rate is expected to rise 10 percentage points to 13%. Every 5 points in tariff increase reduces S&P EPS earnings per share by 1 to 2%. That's a pretty big stat there. Inflation could spike to 3.5 from tariff pass-throughs, and impact expected to fade over 2026. So the tariff impact, it's probably about the strongest it's going to be now. It's going to start getting better. AI has created a massive economic boom. There's no question about that. $400 billion in CapEx. So companies have spent $400 billion keeping up with the AI demand. Forecast is that's still going to be up to $540 billion. And in 2027, there'll be $629 billion spent on AI. Still very early in the boom. I'm not going to repeat those bullet points. Economic summary, key themes. GDP growth is strong at 4.3. Inflation is above target, but moderating. Employment is cooling. I would pretty much put it at weak. Fed policy is on hold. Consumer spending resilient. That's based on holiday spending numbers. Tariffs, we still have a lot of high uncertainty. Overall, if you net all this out, it's still a fairly bullish picture. Okay, now moving into the stock market, the S&P ended up the year at almost 18% increase. That's just amazing. It closed at 69.66, and Goldman thinks it's going to hit 7,600 this year. As much as I'm a contrarian, And I don't want to agree with that. Based on everything we just said about the economy, about consumer spending, this really could happen. We could see a 7,600 S&P by the end of 2026. VIX is at $15. This is near historic lows. It denotes very low fear in the marketplace. The put to call ratio is very bullish. This is telling you that for every call that it's bought, there's only 0.83 of puts bought. So the market, a lot more calls than puts. VIX is, as I said, near historic lows. The current is at 15, well below the panic threshold at 30. For me, I start looking at above 25 on the VIX. Like, be careful. 30 is, wow, you want to watch that. Low volatility has been favorable for continued upside in the market. If volatility starts spiking, it's usually because prices are going against us. VIX can also precede sharp reversals. VIX is a great thing to watch if you're curious about the overall markets. You want to watch for spikes above 20 as early warning signals. There's a threshold. It depends on timing, but 20 is not a bad number. When VIX surpasses this number, it's not a bad time to buy some calls because oftentimes it will double. It has a tendency to really spike. And we talked to the put to call ratio. S&P option flow is neutral. Equity options flow is very bullish, and CBOE is bullish. So this is all arguing that we could have continued rally in the marketplace. We do have a divergence. Equity PC at 0.49. It shows retail traders are aggressively buying calls, which you want. But the S&P PC at 1.09 shows institutions are beginning to hedge for a fall. So which wins? We'll see. Very often it's going to be the equity PC, sorry. Sector outlook, you can see technology just keeps being a champion. Comm services, which I kind of put in the technology bucket these days, especially with AI, very, very bullish. Industrials bullish. Utilities bullish. So even some of the defensive plays are bullish. Financials have been just strong, racehorse strong, now neutral, probably going to see some weakening in the financial sector. And then energy has gone from really strong as a defensive play, caution. We do have an OPEC meeting, I think, this week, so that's going to determine a lot about energy. Earnings growth, 18.7%, which is huge. The amount of companies beating their earnings per share forecast, 77%. And 2026 EPS growth rate is predicted to be 15%. If all remains equal and companies are growing by 15% with their earnings, the stock price should grow by 15%. So if this number became true, you would see another 15%-ish growth for the S&P this year. So watch this number carefully. It's important. Let's see. Valuation. This is probably scares me more than anything. 22.2 times earnings. This is well beyond what we saw when the .com sector blew up. This normally should be around 17 times earnings. So companies are being valued. Every dollar they make, they're valued at $22.20. Wow. 5-star average has been 20, which was already too high. 10-year average, 18.7, getting closer to normal. But if you go long term, you're going to see about a 17 times earnings is a normal number. The concentration of the Magnificent Seven, remember, that's Apple, Microsoft, Google, Amazon, NVIDIA, Meta, and Tesla. It's 35% of the S&P market cap. Wow. Now, these companies are driving the AI revolution, and they deserve the premium valuations based on their earnings power. So the bulls are saying this is okay. The bears are saying extreme concentration creates systemic risk, has historically. Any stumble in these names will drag the entire index. Factual. These companies are beginning to be kind of valued in a basket. And if one apple spoils in the basket, then the other apples will likely spoil. Key risk to monitor: tariffs escalation could reduce earnings per share by 1 to 2%, still leaving them pretty strong. Inflation acceleration, which would delay more Fed cuts, which will begin to slow down the economy again. Mag 7 concentration, always been a risk. Elevated valuations scare the hell out of me. Geopolitical tensions. Normally, I said this last week, in my life, in terms of really looking at the economy and studying the economy, most of these global tension areas would have created massive sell-off in the market. The market is completely numb to geopolitical tensions. I don't know if it'll stay that way, but it's been that way, and it's getting worse, which starts removing the chance of a black swan event, because most black swan events come from geopolitical issues. From the upside, we have stronger than expected AI adoption, and I think we're early in on that. Tax cuts are providing the consumer a tailwind. Broadening market leadership, meaning the Mag 7 is not quite as concentrated as they were, and the Fed may pivot to more aggressive easing, especially if we get a new Fed chairman in May, and productivity gains are exceeding forecasts. So just to look at the market in summary, a VIX at 15 says we're complacent. Put to call ratio is bullish. Earnings are extremely bullish. Valuations are extremely stressed. Fed policy is neutral, and tariffs present a risk. Net it all out, I think you still have somewhat of a bullish market. Before I go, let's look at some stock picks real quick. We had another great time on these picks. Let me just blow this up here. And of course, we'll finish with this week's stock picks. So first pick was Boeing. We said to enter it if it climbs above 229. And I think this was pre-market. And this was where are we here? Yeah, sorry. So we climbed above, this was, I think, Tuesday. And the stock ended up going from 227.81 up to 233. That was a $6 climb. And even if you got out on the first run up when it pulled back, that was still about a $4 climb. So Boeing was a very good stock pick. Baidu got right up to the number I told you. Remember, you never buy these unless we close above the number I give you. That was 151.10-ish. The wicks tell us that it tried to go above, but it never closed above the line, and then down it went. Very often, these levels that I pick are explosive. Either when stock price is going to cross them and it's going to run, or it's going to fail and it's going to fall. So you want to be really careful that you make sure that the stock closes. This week, I'm looking at Chevron. I would only buy it above 162.80. There's your target. There's your stop. Last but not least, Starbucks. I would only buy it above 89.50. Personally, I think it's a little bit due for a bit of a comeback rally, but make sure it crosses 89.50. Last but not least, and I haven't been doing this often, but I did want to show you this week's results, which were phenomenal. I'll start by showing you this because it's really visual. So this was January 5th here. Looks like we entered one of these trades on the 2nd. The rest were the 5th. And so this is one options contract, which on average you would have spent, oh, that's wrong. Hang on here. Let's fix that real quick. You know what? It's going to take, I don't want to do this. So the most you would have needed for any of these trades was $319. And for the week, we made $177, one contract. So 10 contracts would have made you $1,777, and it would have cost you at most $3,100. So $3,100 to make 177. Tuesday, the most you would have needed was $140. 10 contracts would have taken only $1,400 and you would have made 800. Next, these are real numbers. And not only, are these real and true numbers, almost all of these trades were taking with our members in the live trading room. So our members are able to follow me into each one of these trades. On this particular day, the most you would have needed was $365. And if you had that, because remember, these trades are not, they're not taken at the same time. They're all separate trades. So basically you're using the same capital over and over and over. It's not a total of the capital. It's the highest number, or you could look at the average number, but the highest 10 contracts would have taken 3,600 and you would have made $2,200. And then the next day was 190. Highest needed was 690. And then Friday, I didn't trade very much, but the most you would have needed was 450, and you would have made 66 per contract. So again, 10 contracts would have been $660 for the week. 250, 40, 470, 550, 650, about seven. Actually, I have it here. It's about $700. Here's the dashboard. Oh, great. What's going on here? Well, so we talked about these trades, but you can see every single trade. You can see how long we were in them. You can see the profit and loss. And then if you look at the dashboard, hopefully it'll populate this time. We had 28 trades with 25 wins, 3 losses. That's how much we made. And that's on one contract only. This says 4 contracts because it's designed to tell our members how many contracts they can and should trade based on their profits. We only gear with profits. So then this is just for 1 week. Okay, guys, that's it. We have another webinar on Thursday. We're going to talk about options. How do I use them? How do we make money at them? And how can you very safely trade with us? Okay, guys, so look for that link, and I hope to see you on Thursday's webinar. See ya.